All right, let's jump right into this. Welcome to today's explainer, where we are going to put on our professional sell-side equity analyst hats to rigorously decode KOPN based entirely on their latest filings. Now, I have to tell you, this stock presents one of the market's absolute most fascinating and, frankly, most baffling valuation mysteries we've seen in a while. So, if you love digging into fundamental valuation, crunching the data, and trying to figure out exactly what on earth the market is thinking, well, you are in the perfect place. Here is our roadmap for unpacking this mystery today. First, we'll cover the KOPN stock phenomenon, then look at their business fundamentals and growth, check out profitability and efficiency, break down their pricing and valuation multiples, and wrap it all up with our final takeaway. Okay, part one, the KOPN stock phenomenon. Is it truly a market outperformer? 408%. Seriously, just let that sink in for a second. This staggering figure is KOPN's total return compound annual growth rate, or CAGR, over the trailing 12 months. Just to put that into perspective, the broader market usually aims for, maybe 8 to 10% a year? A 408% total return over a single year showcases immense, almost euphoric market enthusiasm for this specific equity right now.
But here is where things get completely wild. Look at this dramatic juxtaposition. We've got a skyrocketing stock price paired with severely shrinking top-line revenue. While the trailing 12-month price CAGR is up nearly 400%, the actual revenue the company is bringing in over that exact same period has contracted by almost 22%. Normally, standard valuation theory says stock prices follow earnings and revenue, right? But here, they are moving at breakneck speeds in completely opposite directions.
Let's move to part two, business fundamentals and growth. Time to look under the hood. So this revenue contraction we just mentioned, it's not just a temporary dip. It's a trend that is rapidly accelerating over time. If we look back 5 years, revenue is virtually flat, down just 0.4%. Over a 3-year horizon, that contraction widened to negative 6%. But in the trailing 12 months, it's plunged to nearly negative 22%. The core business is shrinking, and it's shrinking at an accelerating pace. Furthermore, when we evaluate the bottom line in the filings, we see a classic accounting illusion. While trailing net income appears slightly positive at roughly $2.5 million, the underlying unlevered free cash flow, which, as we know, is what truly matters when we're trying to build absolute valuation models like a DCF, tells a much harsher story. The company is bleeding nearly $17 million in free cash flow. This means their daily operations are heavily consuming cash, despite what that headline net income figure might suggest. Now, to be fair, there is one major saving grace in this fundamental breakdown: zero debt. Their debt-to-equity ratio is a perfect 0. This is absolutely crucial because it means they aren't currently burdened by mandatory interest payments or impending debt maturities while they navigate this severe operational contraction. It's essentially the financial lifeline keeping the company afloat while they burn through that $17 million in free cash flow. Right, on to part 3, profitability and efficiency. Let's talk about squeezing the margins. Before we throw more numbers at you, let's quickly define return on invested capital, or ROIC. As any fundamental analyst will tell you, this is the ultimate test of management's ability to turn capital into profit. Simply put, if you give a company $1, how efficiently do they use it to generate a return? Unfortunately for KOPN, their ROIC is sitting at a really tough negative 22.32%. This indicates severe inefficiencies in their capital allocation. Basically, for every dollar invested into the business operations, they are destroying over 22 cents of value. And honestly, historically, it's been even worse, with the 3- and 5-year averages sitting deep in the negative 70s. We can see exactly where that inefficiency happens when we check out the margins. They actually maintain a respectable 28.5% margin on gross sales, meaning their core product has some baseline profitability. But the operational costs? They completely devour that. By the time we get to the bottom line, the trailing net profit margin is an abysmal negative 30%. The cost of running the business vastly outweighs the gross profits they pull in. Moving to part 4, pricing and valuation multiples. Is this stock priced for perfection? So as analysts, looking at the premium multiples investors are currently paying, we really have to pause and ask whether these valuations make any logical sense based on the fundamentals we just pulled from the documents. Remember, this stock is up over 400% this year alone.
When we perform a relative valuation against peers, the enterprise value multiples are completely disconnected from standard value investing principles. The market is currently paying nearly 22 times sales for this stock. For context, that means you're paying $22 for every dollar of revenue the company brings in. And remember, that's not profit, just revenue, for a company whose revenue just shrank by 22%. Furthermore, the EV to EBITDA multiple is deeply negative at -61, purely because the underlying earnings are so incredibly poor. Because the company generates no meaningful trailing earnings, the traditional trailing price-to-earnings ratio is technically zero, or rather, mathematically undefinable. This forces the market to look strictly forward, pricing in an incredibly optimistic forward PE of 85. So investors buying in today are paying a massive premium on the sheer hope of future earnings that simply do not exist anywhere in the current historical data. This is exactly why rigorous absolute equity valuation models completely break down here. When we try to build a standard discounted cash flow model, a dividend discount model, since there's no consistent dividend policy anyway, or even an adjusted present value approach to separately value tax shields, the data explicitly yields a fair value price of not applicable. You literally cannot build a reliable DCF or APV model when unlevered free cash flow is severely negative and the top line is actively shrinking. Even trying a sum of the parts or net asset value liquidation approach falls short because the core operational cash drain mathematically evaporates the intrinsic value. Finally, Part 5, the final takeaway. The ultimate contradiction. To synthesize everything we found in the filings, KOPN represents an extreme market paradox. On one hand, you have extraordinary, market-beating stock returns, but on the other hand, those exact returns are masking a fundamentally shrinking business that is burning cash, destroying invested capital, and is currently priced at massive, speculative premium multiples that defy every single traditional valuation model we've got. Which leaves us with this final, provocative thought. Will financial gravity inevitably pull this valuation back down to earth as the fundamentals take hold? Or is this momentum truly unstoppable because the market knows something about KOPN's future that trailing data simply can't see yet? It is a fascinating standoff between wild price action and fundamental reality. Thanks for joining me on this explainer. I'll catch you next time.